Good evening, everyone. Thanks for joining. I'm Christy Schmidt, Director of Marketing and Communications for Farm Credit East. Before we get started, just a few technology tips. All attendees will be muted throughout the presentation. Every once in a while, just be sure to tap your mouse so that your screen doesn't go to sleep. And there will be a time for questions and answers at the end of the presentation, but you can text chat them in at any point during the presentation. So there should be a box in the upper right-hand corner of your screen with a red arrow. Just expand that and you'll see a text box area where you can text chat in your questions and they'll come into us, and again, we'll ask them of the presenter at the end. Finally, a recording of today's presentation will be available at farmcrediteast.com/webinars for playback at a later time. If you're having any trouble accessing this recording, you can contact me at 800-562-2235. And now I'll pass it over to Bob Smith to get started.
Okay, good evening, everyone. This is Bob Smith with the Knowledge Exchange Program of Farm Credit East, and I would just extend my welcome to everybody on this webinar on the Affordable Care Act. We're very excited about this webinar. We've probably done 30, 40 webinars over the past 5 or 6 years. This is our first evening webinar, so we're excited. We hope you find it helpful, useful. And at the end of the presentation, we will have a slide, and if anyone has suggestions for future webinars, please let us know. As Christy said, there will be a recording of this webinar available at farmcrediteast.com. And that throughout tonight's presentation, we're going to hold questions till the end, but throughout tonight's presentation, as an issue comes up and you want to ask a question, please text chat that in to us. And then we will go to the questions as soon as Sheldon gets done. We have a number of great farm and forest products businesses with us tonight. I want to thank our special sponsoring and supporting organizations that joined with us in promoting tonight's webinar: the Professional Logging Contractors of Maine, the Northeast Agribusiness and Feed Alliance, the New York State Vegetable Growers Association, New England Farmers Union, New York Farm Viability Institute, NEDPA, the Northeast Dairy Producers Association, the New York State Agribusiness Association, New York Farm Bureau, and Cornell University Cooperative Extension, a number of great organizations, and we appreciate their help in getting the word out on this webinar. We're very pleased to have as our special guest presenter tonight, Sheldon Blumling. Sheldon, many of you may have met. Sheldon was with us back in February 2014 for a number of face-to-face meetings where he came to the Northeast, put up with temperatures below zero, and drove between Atlantic City, New Jersey and Syracuse, New York in about a foot of snow. But did 4 face-to-face meetings over a 4 or 5 day period, and did a great job. So Sheldon's back with us, and we greatly appreciate that. We're thrilled to have him tonight for our presentation. Sheldon is a partner with Fisher Phillips and LLP, and he chairs the firm's Employee Benefits Practice Group. He advises clients with respect to all aspects of employee benefits and executive compensation, health and welfare benefit programs. He also advises employers on various compliance issues, including health insurance laws and all types of federal and state employment taxes. He joined Fisher Phillips in 1998 in their Atlanta office, and now works out of their Irvine, California office. He's a graduate of the University of Miami School of Law, did his bachelor's at Arizona State University. He is really one of the key experts, if you will, in health, employment law in general, and we're thrilled to have him to present tonight. So with that, let me turn this over to Sheldon. Sheldon?
All right, thank you. Good evening, everybody. So we're going to talk about the Affordable Care Act tonight, and of course the focus of this webinar is going to be the impact on employers. So I do a lot of speaking on the Affordable Care Act, and everybody sort of comes at it, from a different angle depending on what they're interested in. Some are interested in the insurance angle and the individual angle. Our focus is going to be on what it means for employers and the key issues there. So here's what I want to go through tonight. I want to start out by just kind of talking about where things stand today with the ACA. You know, it was passed over 5 years ago. You think we'd have a handle on that, but the reality is there's been so many twists and turns in the implementation of this massive law that I find myself always having to start there, sort of, you know, where do things stand now? So we'll cover that, and then we'll get on to what, you know, I think is sort of the main event tonight, which is a refresher for everybody on the employer mandate. You know, this is the part of the ACA that says if you're a large employer that averages at least 50 or more full-time employees, you have this new obligation to offer affordable minimum value coverage to all of your full-time employees, or if you don't, you'll be subject to a penalty tax. And it's a very complex part of the law. It's also the part of the law that I think has the biggest impact on employers. It's probably the reason that a lot of you are here tonight to listen to this webinar. So that's where we're going to spend most of our time. And then I want to end the program with talking about some key considerations for agricultural and forest product employers. We do a lot of work in that industry, and you know, we've seen some of the key issues that employers in those industries are dealing with. Okay, so where do things stand now? I think it's still fair to say that the ACA is a moving target. Still a lot of activity that's going to impact what this law looks like going forward in the future, and frankly, you know, how it's going to look like in the very near future as the implementation rolls on. You know, most of you were probably following the news the last couple years about the two big Supreme Court cases that were challenging key parts of the law. Of course, we've moved past those Supreme Court cases at this point, and the law you know, survived those two challenges. There's still a little bit of judicial activity out there, nothing quite as significant, but what we're seeing recently, in fact, is still a fair amount on the legislative front. Which is interesting because, you know, not a lot has happened with this law on the legislative front since it was initially passed. And, you know, the primary reason for that, it's a very, you know, politically charged law, and it's difficult to get Congress to agree on any changes. What we see sort of on a regular basis is a number of efforts within Congress to repeal the law. It used to be that these repeal votes would make the headlines, and you'd read about them on the front page. Frankly, it happens so often that it really doesn't even make the front page anymore. The last I counted, we were over 50 attempts within Congress to repeal the law. Of course, most of that's coming out of the House, which is controlled by the Republicans. So anyway, we continue to see those, although for those of you who are following sort of the political landscape, not likely that any of those are going to succeed at least anytime soon. But what's interesting is we actually had a couple of amendments to the law very recently that passed, and one of the reasons that these two amendments were able to slip through is they had bipartisan support. There was, you know, sort of universal agreement that it made sense to make a couple of changes. Back in July of this year, there was an amendment that really did not get a lot of press, where Congress tweaked the law so that when you're running the test that we're going to talk about a little later to figure out whether you're a large employer subject to the mandate, that's this, do we have 50 or more full-time employees on average? They changed it so that you could exclude from consideration in that test any employees who were covered by military coverage, whether it's TRICARE, VA coverage, or any other type of military type coverage. And the theory there is if you're a smaller employer and maybe you're right on the cusp of 50 and you're not sure whether you want to hire anybody and cross that 50 mark, you might be interested in hiring a veteran who has military coverage because they wouldn't count for purposes of this test. So I don't know how likely it is that particular tweak in the law would affect anybody out there today, but I wanted to make sure that you knew about it. And again, it's sort of an example of one of the very few changes that Congress can agree on. The next one was actually just passed about 2 weeks ago this month, and we've seen a little bit of press on this, but not a lot. And part of that, part of the reason for that is it's slightly confusing. The ACA changed some definitions in the insurance market of what's considered small group coverage and what's considered large group coverage. Now, the reason that this is relevant is small group coverage for employers is highly regulated. It's subject to the so-called community rating rules, where the carriers can only set the premiums based on a limited number of factors. And basically, if you're a small employer and you go out into the insurance market, you're going to find pretty much off-the-shelf, highly regulated products. The price is going to be the same just about wherever you go as far as the coverage from a particular carrier. There's no health underwriting or any underwriting whatsoever really that goes into it. The large group market for employers, on the other hand, is what I think most people think of when they think of the health insurance market for employers, where you submit a bunch of data about your group, and the carrier looks at that data, runs it through its underwriting black box, and spits out premiums based upon how the group is underwritten. Traditionally, prior to the ACA, the small group market was the 2 to 50 market. So if you were above 50, you were in that large group market where you would get underwritten. There was a provision in the ACA that said, starting in 2016, the small group market would be increased to the 2 to 100 range. And the reason that's important is, there are a lot of employers in that 50 to 100 space who probably liked the coverage that they were getting in a large group market, particularly if they had, a fairly healthy group of employees. They had good rates. The rates were based on their group, and they were sort of, plugging away just fine. If they were then thrust into the small group market starting next year, they would have to change their policy, buy one of these, highly regulated small group policies, and in a lot of cases, the premiums would have went up because of the way those small group policies were underwritten. So Congress got together and basically eliminated this mandatory expansion of the small group market. But what they said is, we're going to leave it to the states. Each state can decide on its own whether it wants its small group market to remain in that 2 to 50 space or go to the 2 to 100 space. And the reality is, a lot of states had already changed their laws to line up with the ACA. So what I think we're going to see over the next couple months is a lot of debate at the state legislature level as to whether or not to go back and tweak state law and bring it back down to the 2 to 50 range. And so that's something to keep your eye on if you're in that 50 to 100 space where this may impact the type of insurance product you can get. The last thing I wanted to mention was the Cadillac tax. You're reading a lot about that lately. This is the 40% excise tax on the excess cost of coverage. Basically, when we get to 2018, if the value of your insurance coverage is above certain limits, there's going to be an excise tax of 40% on the value above those limits. The theory being that you have a plan that is too rich. It's providing benefits that are too expensive, that are too much of a burden on the system. And a lot of people don't like the Cadillac tax because it's going to cause a lot of employers to have to basically reduce the value of the benefits under their plan. And so there's been a fair amount of debate and proposed legislation in Congress to perhaps repeal the Cadillac tax or change the way it works. Nothing has made it through just yet, but I think we're going to see a fair amount of activity on that in the next several months. Okay, so the other thing we're seeing is just a continuation of a lot of regulatory guidance. Tens of thousands of pages of regulatory guidance have been issued on the ACA. Again, it's a very complex act. You would think with that much paper they would have nailed down every detail by now, but the reality is it's just impossible to nail down every detail. Even with all of that regulatory guidance, there's still a lot of questions that remain, and I think it's going to be a lot of years before everything really does settle out. So, when we get to the questions later on, if you ask me a question and my answer is, I'm not sure, I don't know, or it's not specified in the guidance, I will tell you that that's oftentimes the answer to some of the more detailed questions because they just haven't managed to nail down every single detail. All right, so what's happening in the real world in the meantime? Well, as most of you know, we had all the state insurance exchanges and the federal exchange open up in 2014. This is where individuals go to buy coverage, where it's guaranteed issue coverage, where if they're eligible for a tax subsidy, they can get a tax subsidy that either reduces or eliminates the cost of coverage. We had the individual mandate begin in 2014. The thing that I don't see a lot about with the individual mandate, I don't see written about it, is the penalty is really starting to kick up. So most of you may remember it started out where in 2014, if you didn't have coverage, when you filled out your tax return, you were going to have to pay a penalty that basically amounted to $95 or 1% of your income. Well, that penalty is ratcheting up pretty quickly. This year it's up to $325 or 2% of your income. Next year it goes to $695 or 2.5% of your income. So I will tell you, for those of you who've been maybe getting questions from some of your employees about how all of this affects them and do they have to worry about a tax penalty, when we get to next year, we're talking about real money for most people. A $695 penalty or 2.5% of your income. You compare that against what it might cost you to buy coverage. There's a lot of folks that are going to make a decision to buy coverage rather than pay that penalty because it's ratcheting up quickly. This year we had the employer mandate finally come to pass. I say finally because it was supposed to be effective in 2014. It took the feds longer than expected to get all of the regulatory guidance out. You can see there, most of it came out in 2014. So what they did is they pushed it back to 2015. And in fact, just recently in September, they finally issued the final guidance on how to do the tax reporting for 2015. So you can see that they're still sort of in catch-up mode in issuing some of the important guidance for employers. Now, most of you probably remember there was a lot of caveats and transition rules that applied to the employer mandate in 2015. The permanent rule says that you're subject to the mandate if you average 50 or more full-time employees. But for 2015, there was a reprieve for the most part for what I call medium-sized employers, or those in that 50 to 99 space. So you were basically looking at your head counts in 2014, and if you got the average under 100, you were off the hook in 2015. We saw a lot of one of the transition rules created some delay in a lot of respects if you had a non-calendar plan year. So a lot of folks have a January 1 renewal and their plan runs on a calendar year, but for those who had maybe a July 1 renewal, there was some guidance that said, well, instead of having to start on 1/1/15, you could push out your compliance out to 7/1/15. So that helped out some folks. And then, of course, we had this transition rule that let you, look at your employee counts over a 6-month period in 2014 instead of over a 12-month period, which is the permanent rule. So, those rules probably helped some of you out there on the phone, maybe to push things out a year or part of a year, or maybe that head count thing helped you out for this year and you were under the 50 mark, but it's not going to help you for the next year. So the transition relief was good while it lasted. The big debate has been over the last 6 months or so is, were we going to see anything more in the way of delays or transition relief from IRS? And thus far, we haven't seen it. I put the quote there in the slides, and this is sort of an interesting quote where IRS, when they issued all the other transition rules, they explicitly said, we're going to take a look at all of this, and we'll see if it's necessary to extend any of this beyond 2015. At this point, they haven't done that. And I think we're late enough in the year where I wouldn't hold my breath. So for those of you who, maybe are in that 50 to 99 space and you got a reprieve for 2015 and you were banking on perhaps getting another reprieve for 2016, I wouldn't bank on it. I think we're going to march in 2016 with the regular rule, which draws the line at 50. Okay. Now, a few other things that I think are worth mentioning before I move into the employer mandate refresher, and this again relates to some of the more recent guidance over the last 6 to 12 months. And I see this sneak up on a lot of particularly small to medium-sized employers. It used to be fairly common for a smaller employer to say to their employees, look, we're not going to go set up a health plan, but we're happy, if you want to go out and get your own coverage or you want to get coverage through your spouse, however you want to do it, we're happy to reimburse you, up to X per month to help you pay for part of the coverage. It was a fairly common thing. At the end of 2014, the IRS came out with some pretty controversial guidance where they basically eliminated your ability to provide reimbursements for employees. It is no longer permissible to reimburse an employee for coverage that they buy in the individual market, either whether it's out on the street through a broker or whether it's through an exchange. And this is you can't do it on a pre-tax or an after-tax basis. The theory behind this is the IRS treats that reimbursement arrangement as a health plan, and it happens to be a health plan that doesn't comply with any of the rules because it doesn't offer major medical and pharma and all these other things that you have to provide in a health plan. It's just money. And so by casting it as a health plan, that basically makes it so you can't do it. There's actually a $100 a day penalty for every day that you have a reimbursement arrangement in effect for each employee that is covered under it. So it's quite a penalty exposure if you're doing this. Now, the one thing that IRS did say is that you can still, of course, pay somebody more to make up for the fact that you don't offer benefits. So you can't say to an employee, well, go get your own coverage and I'll reimburse you up to $100 a month for the cost, but you can say to an employee, look, we don't offer coverage, and so we're going to pay you an extra $100 a month to make up for the fact that you have to go out and get your own coverage. And the key distinction there is that you're not conditioning that extra compensation on them proving that they have coverage. In other words, it's not a reimbursement. It's just, frankly, extra pay to make up for the fact that they're not getting benefits. So you can still do that. We still run into clients that, instead of increasing somebody's hourly rate or increasing their salary, they'd rather pay it as kind of an earmarked stipend or bonus. Just be careful about the way you do that. You want to make sure it's not labeled a healthcare reimbursement or a benefits reimbursement. If you want to call it out as a benefit-specific type payment, I would call it a benefits stipend or a benefits bonus. I wouldn't even use the word healthcare. And just make sure that no matter what you call it or how you label it, that it's treated as a full taxable wage like any other bonus when you run it through payroll, because there is no basis to do it on a pre-tax basis. So keep that in mind if you've been looking at reimbursements or if you've had one in place. The other guidance that I think was pretty controversial, that was a surprise from IRS, is how they treat waiver payments or opt-out payments. And what I'm talking about there is a lot of employers would offer employees a plan, and they would say, look, if you decide not to sign up for the plan, we'll pay you $50 a month. And the reason you might do that is if they decided to sign up, it was going to cost you $200 a month. So for everyone that opted out and decided to do without or get their coverage elsewhere, sure, you were paying something for that, but it was a heck of a lot less than the $200 a month you'd pay if they signed up. It's a pretty common tool that a lot of employers would use. So the IRS came out and said, look, it's okay to have these opt-out payments, but we're going to treat the opt-out payment as basically part of the employee's cost of coverage when we look at affordability. So for example, let's say you tell an employee, here's your offer of coverage. The cost to you is $100 a month, but if you decide to opt out, we'll pay you $50 a month. So when you're doing your affordability test to figure out whether the cost of your coverage is affordable for an employee, the IRS would say we're going to treat that employee as having to pay $150 a month because it's $100 out of pocket, plus they have to walk away from a $50 opt-out payment that they would get if they didn't take the coverage. And for a lot of employers, adding that opt-out payment into their cost of coverage was the difference between the coverage being affordable or not affordable. So make sure if you have a waiver payment or an opt-out payment, you're taking that into account when you're calculating the cost of your coverage and whether or not it's affordable. It's a big surprise there when IRS came out with that position. Okay, so that's the latest and greatest as far as where things stand on the guidance. Next, I'm going to move on to my employer mandate refresher, and I always like to start this with a reminder of the big picture, because it's really easy to get bogged down in some of these really detailed rules and forget about what's going on here from a policy perspective. It's very clear that the primary policy of the ACA is to get people covered, either through government subsidized coverage and exchange, or through employer coverage, which in a lot of cases has to be affordable now. So the employer mandate is an important tool in the ACA that furthers this policy goal to get people covered. I will tell you that in working with a lot of agricultural employers throughout the years, I very often will get a question or a statement like, look, there's got to be an exception for our industry or our business. The work that we do is very different than a lot of other employers. We have a lot of seasonal workers. In some cases, we have guest workers. There's got to be an exception. And I hate to break the news to you, but there is no exception or specific solution for agricultural employers. And what I always tell my clients is, look, there's no exceptions for not-for-profits. There's no exceptions for churches or religious employers. There's no exceptions for government employers, even state and local government, subject to these very same rules. So just remember, there is no exception. Now, there's a few key issues that are useful in some respects for the agriculture industry, and we'll talk about those in a minute. But definitely no exceptions. And just to hammer that point home with this last bullet. We and others wrote to the IRS a lot of comments and made a lot of persuasive arguments, in my view, that there should have been an exception in these rules for guest workers. And the IRS very specifically declined to create an exception. So if you are using guest workers that are lawfully present in the country on an H-2A visa, they count as just like any other employee. There is no exception for them. So just keep that in mind when you're thinking about how these rules are going to affect your business. Okay, so let's talk about the mandate. And we have to start with how do you determine if you're a large employer subject to the mandate? As I mentioned earlier, the basic concept is you're a large employer subject to the mandate if on average you employ 50 or more full-time employees, including full-time equivalents. Now, I've made the note there in the slide that it was a slightly different rule for 2015. There it was if you had 100 or more full-time employees, but the permanent rule and the rule that applies starting in 2016, it's a 50 or more test. Now, how do you determine who's a full-time employee? Well, a full-time employee is an employee who on average works 30 or more hours per week. Now, most of what you're doing when you're looking at employees and evaluating whether they're full-time is you're looking at a month, a calendar month. And so the monthly equivalent of 30 hours a week is 130. It's 4 1/3 weeks times 30 hours a week. So that's what we're going to focus on as our full-time standard as we look at this issue for various purposes under the rules. Now, keep in mind that a lot of employers have their own definition of what it means to be full-time. Used to be that you'd see 40 hours a week quite a bit. This rule does not dictate how you define full-time employee for the various things that are under your control, like who gets vacation benefits or who gets sick benefits or holiday pay and things like that. You can still define full-time for that purpose at 40 hours a week or whatever makes sense for your business. But for purposes of the employer mandate and your group health insurance plan, the new standard post-ACA is a 30-hour-a-week standard for full-time. So let's move into the mechanics of this 50 or more test. You're always looking to the prior year. So for example, if you want to determine whether or not you are a large employer subject to the mandate in 2016, you're going to look at your employee counts in 2015. You're always looking back to the prior year. So for example, let's say you run the numbers and you end up averaging 48 full-time employees through 2015. So then in the first quarter of 2016, maybe you buy another business, or for whatever reason you balloon up. You double up to 80 employees, let's call it. That's not going to affect you for the rest of 2016. You already averaged 48 during 2015, and so you're good for 2016. You're not going to be treated as a large employer. Now, if you balloon up, that may affect you for the following year, but it's not going to affect you in the year in which it happens because you're always looking back to the prior year. What you're doing for this 50 or more test is a month-by-month determination, and I'll walk through what that looks like in a minute, but the basic concept is for each calendar month of the year, you're adding up the number of employees, figuring out how many you are employing, and then you're going to divide it by 12 so that you get an average across the year. It's a month-by-month thing. This test is done on what's called a controlled group basis. The concept of a controlled group is that sufficiently related employers are treated together as a single employer for a number of rules under the tax code, mostly the rules that dictate employee benefit plans. And so the simple example is, let's say you have a parent company and then 3 wholly owned subsidiaries. Each of them is a separate company. Each of them has its own separate EIN number. But for purposes of these rules, all 4 are treated as one single employer for purposes of this 50 or more test. It doesn't matter if they're all in the same industry or a different industry. All that matters is that the 3 subs are wholly owned by the parent. You just look at the ownership, and so they're all tied together. Now, likewise, you might not have a parent company, but you might have 3 operating subsidiaries that are all 100% owned by the same individual or the same family. In most cases, as long as there's at least 80% common ownership of those separate companies, they're all going to be tied together for purposes of this 50 or more test. So this is a very important thing to keep in mind if you're part of a business where there are brother and sister businesses, or maybe there's a parent company and other subsidiaries. If it's a family-owned company where maybe there are multiple different operations, you got to know which ones are going to get tied together for purposes of this test. Okay, so let's go through an example of how you run the numbers on this 50 or more test. And so let's just, for the sake of this example, let's talk about January of 2015. That's a month that's already in the bag. So you go back and you dust off your payroll data for January of 2015. Here's what you're going to do. First, you're going to look for each employee who worked at least 130 hours during the calendar month of January of 2015. Each one is going to count as a full-time employee. So in my example, we look at the payroll records. We have 30 employees who each worked at least 130 hours. Now, oftentimes I'll get the question, well, what if I had an employee who worked 260 hours? Does that mean that they count more than once? And thankfully they don't. There's a lot of quirks in these rules, but they haven't come up with a way to determine that one person counts as 2 full-time employees. So we can be thankful for that. Once you know that somebody hits at least 130 in the calendar month, they count as one, and you can just move on from there. So again, in my example, we have 30 people that are full-time for certain. But then there's another 35 people who worked less than 130 hours. So we'll call these folks part-timers. And in my example, just to keep it simple, each of them works 100 hours each during the month of January 2015. So what we do there is we have to take those employees and their hours and convert them to full-time equivalents. So we take 35 employees, we multiply it by 100 hours each. That gives us 3,500 hours total. We divide that by 120, and we go out 2 decimal points. And I'm not making that up. It's right in the regulation. You go out 2 decimal points. And so what you end up with here is 29.17 full-time equivalents. Now, some of you out there might be scratching your head saying, wait a minute, why are we dividing it by 120? I thought you said the rule was 130 for full-time. That is not a typo. For whatever reason, they decided that when you're figuring out full-time equivalents, you're dividing it by 120 instead of 130. I can't really explain why, but that's just the rule. So you can thank Congress and the IRS for that. Okay, so in my example, we end up with 59.17 full-time employees and full-time equivalents for the month. Now, this is a great example of, even though you don't have a full-time staff of 50 or more, you could still be over the 50 mark when you start factoring in your part-timers. So make sure you're keeping those part-timers in mind when you're running the numbers for this. So what we did is we just went through one example for one calendar month. You're going to run the numbers the same way for each of the other 11 calendar months in 2015. You're going to take each number that's already out to 2 decimal points and add it up, and then you're going to divide it by 12. And then you're going to take that out to 2 decimal points. If it's 49.99, you're not a large employer for 2016. You're not subject to the mandate. If it's 50 or more, or 50.00 or more, then you are a large employer and you are subject to the mandate in 2015, or I'm sorry, in 2016. So this is the math that you're going to have to run if you're close. If you're in that sort of, maybe 40 to 60 employee range and you're not quite sure where you're going to end up, you need to be running these numbers every month and, keep a running total so you can see where it's going to steer in as we get into the last 2 calendar months of the year. Now, there's a special exception to this 50 or more test, and this is one of those exceptions that's unique in many respects to the agriculture business. It's called the seasonal worker exception. And just so we're clear, it's not a free pass for agriculture employers. This is not an exception that says, oh, you can forget about seasonal workers. You don't have to factor them into the test. It's not that simple. The purpose of this exception is to take an employer that for most of the year is under 50, but because they bring in a bunch of seasonal labor for a short period of time during the year, it balloons their average above 50 for the year. That's where this exception comes into play. So the rule is if you're only above 50 full-time employees and full-time equivalents for 120 days or fewer during the year, and all of the employees who are in excess of 50 are seasonal workers, then you still won't be treated as a large employer in the following calendar year. So for example, let's say you have a farm and you have a regular, year-round full-time staff of 30 employees. But for June, July, and August, you staff up. You bring in a bunch of seasonal farm labor. Maybe you bring in hundreds of additional people in for those months to do the seasonal work. And because you balloon up so much in those 3 months, it skews your average across the year above 50. That's where this seasonal worker exception will come into play. But it's only going to work if you're ballooning up above 50 for 120 days or less during the year. So we don't see this as a useful tool for all agricultural business, but certainly there are certain situations where it comes into play. I've included in the slides the IRS's definition of seasonal worker for this purpose. There's no question that seasonal agricultural labor counts as a seasonal worker for this purpose, but I thought it'd be interesting if you look at this underlying language, you can see that they've already contemplated that, even if a worker ends up working year-round because they're moving around, from farm to farm or from geographic area to geographic area, they can still count as seasonal labor for purposes of that rule. Now, keep in mind, this is only relevant for the 50 or more test. So, let's say you're a really large farm. I mean, you have hundreds of employees. This isn't going to help you, and it's not going to impact the rest of your mandate obligations. This is really just for the 50 or more test, and for somebody who has a year-round staff of less than 50. It's not going to help agricultural employers with year-round operations. We do a lot of work with farms in the southern part of the country that have year-round operations, and this rule really doesn't help them because of that 120-day rule. And then, for those of you who are kind of scratching your head and maybe, did the math on this before in 2014, where you were allowed to only look at 6 months instead of 12 months, this seasonal worker exception required you to look at all 12 months of the year. You couldn't combine it with that special 6-month rule in case that was something that you had previously looked at. Okay, so that's how you figure out whether you're a large employer subject to the mandate. So what I'm about to do now is to move on and talk about, okay, you've done the math, you are subject to the mandate, what does it mean? What do you have to do? But before I do that, I just want to touch on, well, what happens if you're not subject to the mandate? So let's say you run the numbers and, you averaged 48.9 or 40 or 30 or whatever it is. Well, that means you're not a large employer for the next year, which means you don't have any mandate obligations. So all this stuff I'm about to talk about, won't apply to you for the following calendar year. I don't think that you should necessarily tune out because, maybe you're right on the cusp and it's only a matter of time before you are above 50. And so you really need to understand what it's going to mean when you do reach the 50 mark. But just so I'm clear, if you're under the 50 mark for 2015, you're not subject to the mandate in 2016, which means it remains 100% a business decision for you to decide whether or not you're going to provide coverage to your employees, and if so, how much are you going to charge them for it. So you're sort of in that pre-ACA world that everybody else was in, where it was actually a business decision to figure out what you're going to do. Okay, so let's talk about the mandate and what it means if you are a large employer. Oftentimes you hear the mandate referred to as a play or pay mandate. And the concept there is you have a choice. You can play, meaning you can offer coverage that qualifies and is affordable to your employees, or your other choice is to pay, meaning to pay a penalty tax. So I'm going to start out by talking about what it means to play, because that's what most employers are focusing on. So you have to do 3 things if you want to avoid having to pay a penalty tax. Number 1, you have to make an offer of group health coverage to substantially all of your full-time employees and their dependent children. So the IRS has actually defined what substantially all means for this purpose. The permanent rule next year and going forward is 95%. So you got to make sure you're making an offer coverage to 95% of your full-time employees. One of the transition rules for 2015 to kind of ease the burden was they defined substantially all as 70%. But that was just a one-time rule. The rule going forward is 95%. So you got to make that offer of coverage. Number 2, you got to make sure that at least one of the coverage options that you put out there is minimum value. And so for those of you who read about these things in the papers, minimum value is what you hear referred to as a bronze plan. It's sort of what's considered the minimum level of coverage that counts, if you will. these days. If you want to really get into the weeds, what it means is on an actuarial basis, the plan is covering 60% of the cost of benefits. So you go to the hospital, you got a broken leg, on average, on an actuarial basis, the plan is going to cover 60% of the costs of going to the hospital, getting the cast, seeing the doctor for the follow-up, etc. So the third thing, and this is the one that is the most difficult for a lot of employers, is that at least one of your minimum value coverage options has to be affordable, which means that the employee cost for that coverage does not exceed 9.5% of the employee's household income. We'll talk about what that means a little more in just a minute. Now, I put in this little parenthetical about 9.56% because there's always somebody out there that reads the papers and sees that, well, wait a minute, there was a cost of living adjustment, and the 9.5% actually went up to 9.56% in 2015. That's true. However, the IRS, in its wisdom, did not account for cost of living adjustments in all of its regulatory guidance. So when you look at all that guidance, and at the end of the day, that's what you're having to follow, hardwired in is 9.5%. So my recommendation to clients is stick with the 9.5% until IRS gets around to adjusting its guidance to take into account these cost of living adjustments. Okay, so let's go through an example of affordability, because this is the only way I can get my head around it. So let's take a full-time employee that has annual household income of $30,000. You multiply that by 9.5%, you get $2,850. I'm going to divide it by 12 so that we can kind of look at a monthly premium. And what you get is $237.50 a month. That means that the employee can't be made to pay any more than $237.50 a month for coverage if you want the coverage to be affordable. You go out there and you look for plans. Let's say you find a plan that's $350 a month. That means that the employer has to subsidize $112.50 a month in order for that plan to be affordable. So when you're looking at affordability, instead of kind of focusing on what's the most that you can charge an employee or what's the most that you have to pay, you have to basically back into that. You have to say, okay, I can charge this employee 9.5%, back into what that is, apply it to the total premium, and then you get your employer subsidy, which is the piece that is of most interest to a lot of employers. In other words, what's it going to cost me? In this example, minimum, the employer is going to have to spend $112.50 a month to make that coverage affordable for the $30,000 a year employee. Okay. Now, some of you probably noticed that when we talk about affordability, we're talking about household income. And that's a term of art, and it's exactly what it sounds like. You're actually looking at the employee's total household income, meaning if they had a second job, that would come into play. If their spouse has a job, that would come into play. The problem for employers is you don't know whether your employee has a second job or whether they have a working spouse, or even if they do, how much money are they making. So really the only thing that you know as an employer is how much you're paying the employee. So just to eliminate any potential uncertainty, the IRS has come up with some safe harbors where an employer can basically assume an employee's income is at least a particular amount by using one of these safe harbors. And there's three of them. The first one is W-2 income. So you know how much you pay an employee. You can sit down and kind of pencil out and predict what their W-2 income is going to be by the end of the year. You're allowed to use that to determine how to make the coverage affordable for them. The problem with this one, of course, is if you have an employee whose hours vary during the year, you're not exactly sure where you're going to steer that box 1 W-2 income in. So there still can be a little uncertainty there. Another safe harbor is the rate of pay safe harbor. This one, it's fairly simple if you have a salaried employee. For a salaried employee, you just say, okay, your salary's $1,000 a month. Basically, you can assume $1,000 a month times 12 for purposes of affordability, regardless of what their actual household income turns out to be. With hourly employees, it's a little more complicated because you have to basically take their hourly rate of pay and convert it to a theoretical salary, but you can only use 130 hours. So if you have, let's say you have an employee who makes $10 an hour, you could basically treat that employee as having a $1,300 a month salary for purposes of calculating affordability. Now the reality is if they're full-time, they probably have a salary that's closer to $2,000 a month or higher if, because they're working more than 130 hours, but you're only allowed to assume 130 hours there for the hourly employees. And then last but not least, you have the federal poverty line safe harbor. So the way this works is you take the current federal poverty line, you multiply it by 9.5%, convert that to a monthly amount. If you do the math based on the current poverty line, it comes out to $93.18. So what that means is if you're not charging more than $93.18 a month for coverage, you can assume that the coverage is affordable for all your employees. And so this is a nice, administrative ease tool that, if you can afford to subsidize the coverage and only charge $93 a month for it, you can rest assured that the coverage will be treated as affordable for all your employees. The question is, whether you're going to want to kick in the extra money, because if you go back to my example a few slides back, we had a $30,000 a year employee where you could charge them up to $237.50 a month. So if you decide to make use of this federal poverty line, you're basically paying a lot more than you might have to just for the administrative ease of not having to do the math. So a few things to keep in mind on affordability. Number one, it's based on the cost of employee-only coverage. So when you make that offer of coverage, you have to offer dependent coverage, but you don't have to subsidize the dependent coverage. You only have to make sure that the employee-only coverage is affordable, and you just have to have one of your options meet the affordability test. So a lot of employers, they might have 3 different options, like a cheap HMO option, kind of a middle-of-the-road PPO, and then a platinum PPO for those that want to spend the money. All you have to do is make sure that one cheapest plan meets this affordability test, and then you can charge whatever you like for the other options. In other words, people can buy up without having to worry about affordability. The other thing to keep in mind is all you're required to do is make an offer. I have a lot of employers that say, well, wait a minute, I can put a great offer on the table, but these people aren't going to buy my coverage, and they're going to go out to the exchange and get a subsidy and cost me a penalty. Hey, if you make a qualifying offer and they decide to pass it up, it's not going to cost you a penalty, because your only obligation is to make sure you made a qualifying offer. You don't have to ensure that they actually take the coverage. Okay, so that's what it means to play. Now, you have a choice, right? Your other choice is to pay. And so there's 2 types of penalties that you might pay if you don't satisfy all the obligations. This first one is if you basically don't make an offer of coverage at all, or for some reason you make it to less than 95% of your full-time population. So, I work with some clients here and there who just say, look, this is all too complicated. I'm not going to get involved. Just tell me how much I'm going to have to pay in penalties. So if you don't offer coverage at all, you're going to pay an annual penalty of $2,000 per full-time employee, excluding the first 30. Now, for 2015, you're excluding the first 80, and the reason for that is, remember, you were only subject to the mandate if you were above the 100 mark, so they made a little adjustment there. But the permanent rule going forward, when it's a 50 or more test, is you exclude the first 30. Now, there's a second penalty, and the second penalty is for the employer who does make an offer of coverage to substantially all its employees, but somewhere they fall short. Most likely where they would fall short is for some segment of their employees, the coverage is not affordable. So I have some clients that said, you know what, I'm just going to set my premiums like I always did, and if it happens to be unaffordable for my lowest paid people, I'll take my chances and pay a penalty if I have to. There, you're going to pay a $3,000 penalty for each employee who goes out and gets public, subsidized exchange coverage because your coverage was unaffordable for them. So let's look at a couple of examples. So first, we'll take the $2,000 penalty. This is if you just get out of the game and you don't offer coverage. You got 60 full-time employees throughout the year. You're going to subtract the first 30, gives you a net 30. Multiply that by 2. You're going to pay a $60,000 annual penalty for the privilege of not making an affordable minimum value offer of coverage to all these folks. So you can see there that you get a break on the first 30, which that could be the difference between deciding to pay the penalty or not, depending on your size. Now the $3,000 penalty works a little bit different. In my example here, we have 5 full-time employees where the coverage wasn't affordable. So this is, you set your premiums, but you have 5, minimum wage employees where maybe they'd have to pay 15% of their income in order to buy the coverage. So in my example, even though there were 5, only 3 of them went out and bought subsidized exchange coverage. And maybe the other 2 just decided they were healthy and they didn't need the coverage. Maybe they got it from their spouse, who knows. But in any event, the other 2 didn't go out and get tax subsidized coverage. So your penalty here is 3 times $3,000. And the key here is that you're only paying that penalty on the 3 who actually go out and get the subsidized coverage, not all 5. Okay, so some planning considerations. Remember that $2,000 penalty, you're going to pay that on every full-time head if you decide just to get out of the game and not offer coverage. Whereas if you do offer coverage, not everybody's going to sign up for it, right? So when you're doing the math, remember that the penalty you're going to pay on 100% of your full-timers, but maybe if you buy coverage, you're only spending money on half of them that decide to actually sign up. And then, of course, we talked about that $3,000 penalty. It's only limited to those folks who go out and get the exchange coverage. Now, the penalties we always talk about in terms of annual penalties, but they're technically metered out on a monthly basis. So the $2,000 penalty is about $167 a month. $3,000 is $250 a month. So if you're employing full-time employees for less than the entire year, you're only going to pay, the penalty for the portion of the year that you had the employee on your books. The penalty tax is non-deductible because it's an excise tax. So if you're, if you're for-profit tax-paying employer, every dollar you spend on buying coverage is the deductible expense, whereas if you decide to pay this penalty, it's not going to be deductible. So you want to factor that in when you're comparing the two. Last but not least, we talked earlier about how control group members are tied together and treated as a single employer for purposes of the 50 or more test. Once you get past that 50 or more test, each separate company can make its own player pay decision. So you might have, one farm operation where it makes sense to put a plan in place and do it that way, and maybe you have another one down the road where, for whatever reason, it makes sense just to pay the penalty. You can make a different decision for each of the 2 companies as long as they're separate companies, separate EINs. Okay, a key piece of all of this, of course, is figuring out who's a full-time employee. So if you're a large employer subject to the mandate, forget about full-time equivalents. That's only for that 50 or more test. When you're subject to the mandate, your only obligation, whether it is paying a penalty or providing the coverage, is for full-time employees. So you have to figure out who's going to count as a full-time employee. The statute actually contemplates that you would do this on a month-to-month basis. So you would look at each month and say, okay, did somebody average at least 30 hours a week? Meaning, did they have at least 130 hours during the month? If so, they count as a full-time employee that month. The problem with that is if you have, folks with varying hours, they could flip in and out of full-time status month to month, which really isn't workable from an administrative standpoint. So the IRS came up with this look-back and stability period concept, which sounds complicated, and frankly it is. There's a bunch of overly detailed rules, but the basic concept is pretty straightforward. Instead of having a month-to-month determination, you're going to measure people's hours over a period of time, in most cases a 12-month period of time, and then if they average at least 30 hours a week during that period of time, you would then treat them as a full-time for the following 12-month period. The first 12-month period where you measure their hours is the measurement period or the look-back period. And then the period of time where they're treated as full-time because they made the cut and they qualified is treated as the stability period. And this is how you're going to manage who's going to count as full-time for purposes of all these obligations. Now, there seems to be a lot of confusion out there, and I see it a fair amount in the agriculture industry where employers are assuming, hey, every employee that I bring on, I can basically make them wait at least a year because I can put them through one of these measurement periods and measure their hours before I would ever have to give them coverage. It's not that simple. There's 3 categories of employees under this system. There are variable hour employees, which are employees where on the date of hire you can't really determine whether or not they're going to average 30 hours a week. Most likely you're expecting them to be part-time. There are seasonal employees, which we'll talk about in a minute. And then there are people who are full-time, meaning the day you hire them, you know you're plugging them into a full-time position. For the full-time employees, there's no reason to put them through a 12-month measurement period to see if they're really full-time because you know the day you hire them that they're full-time employees. And so for those folks, the rule is you have to put them, you have this obligation on the first day of the 4th calendar month of employment. So once you get to that 4th calendar month of employment, you're either making them that offer of coverage or you start the clock ticking where you're exposed to penalties. It's only the variable hour employees and the seasonal employees who get put through this 12-month measurement period before they would ever qualify for coverage. Now, the seasonal employee concept is an important one for agricultural employers, but it's a very strict definition. The definition says that somebody can be treated as a seasonal employee only if their customary annual employment is 6 months or less, and it typically begins and ends around the same time each calendar year. And you know, if you think about that type of definition, that's probably what most people would agree you would count as a seasonal employee if you fit into that definition. So if you have a season that's less than a 6-month season, and you're bringing people in, again, you're roughly the same time of year every year for the season. It's less than 6 months. You know, maybe they're going to work 40 hours a week. Maybe they're going to work 60 hours a week. As long as they fit into that seasonal definition, you don't have to give them coverage right away. You can make them go through one of these 12-month measurement periods and see what they average in order to determine whether or not they get coverage. Another key thing that comes into play is this break in service concept. What this says is, look, if somebody doesn't work for at least 13 weeks, then you can, if they come back after a 13-week break, you can treat them as a brand new employee. So what you see here, if you put these two things together for an agriculture employer is, you know, let's say you have a 4 or 5 month season. You bring people in, they're working 50, 60 hours a week during that season, they're done, you don't see them until next year. Well, with that type of employee, you're going to be able to treat them as seasonal, which means you don't have to make them an offer of coverage until they go through a 12-month period. When they leave, you know they're going to be gone for 13 weeks. And so when they come back again next year, guess what? The whole clock starts over again, and you run them through another 12-month period to measure their hours. And basically, they end up on a cycle where they never end up qualifying as full-time for purposes of all of these rules. So if you have a true, you know, a seasonal workforce that fits into this 6-month or less definition, in most cases, none of your seasonal employees are ever going to count as full-time employees. So that's where this comes into play and is a useful tool for agricultural employers. There's some details on this slide about how the look-back and stability period concepts can work. The reality is, if you're in the agricultural business, you're going to use the longest look-back period you can. You're going to use 12 months and then a 12-month stability period. But there is some, you know, some options there if it makes sense for your business. Remember that, you know, you also have to take a look at this for your what they call your ongoing employees, your folks who are with you consistently for at least a full cycle. So you're going to also have like a regular cycle that's running in the background where you're measuring all of your ongoing employees' hours each year to see if they make the cut and are full-time. So you have that along with how you're treating all of the new employees. Okay, A few other things just to keep in mind, and then we'll cover the key issues and finish up and take some questions. So some things that are out there on the horizon. At some point, the ACA had this provision for automatic enrollment where they said if you were a large employer with 200 or more full-time employees, when somebody came to work for you, the deal was you would automatically enroll them in coverage unless they affirmatively opt out. And of course, what that means is more people would end up on your plan because there's a lot of people who are too lazy to sign up. Those same people are too lazy to affirmatively opt out. Now, what happened with this is the Department of Labor decided that they didn't want this to become effective until they could issue some regulations. Here we are 5.5 years later, they still haven't issued regulations. So this is still hanging out there as a possibility. Once the Department of Labor gets around to it, if you're above 200 full-time employees, just keep it in your eyesight, and at some point we may see some regulations, and that will affect you. The ACA also included some non-discrimination rules for fully insured plans, meaning that you'd have to look at whether or not your plan discriminates in favor of highly compensated employees, which is generally going to be the top 25% of your employees ranked by annual pay. So, we see farms out there where, maybe the family gets fully paid rich coverage, and then you have like a level of managers that maybe are one step down, and then from there, you have a whole nother step down for the type of coverage that you're providing for the lower paid folks. That type of thing probably won't work once these non-discrimination requirements become effective. For now, they don't apply to fully insured plans. Again, we're waiting for the IRS to come out with regulations, but just know that that's out there on the horizon, probably sometime in the next couple of years, something to keep your eyes on. And then I mentioned the Cadillac Tax earlier. If you have a really good, rich health plan in place, you've probably already heard something from your broker. If not, you should start talking to them about it, about whether once this Cadillac Tax comes into play, whether it's going to be a problem and cost you a penalty tax. Okay, key considerations for agricultural employers. Here's what we see as we're out there working with these employers as sort of the key issues. Number one, properly identifying the employer. Everything we're talking about today is hinged on knowing who's the employer, who's the employee. The standard under the rules is the common law standard. This can get confusing, though, at times, particularly if you have farm labor contract labor or any kind of leased labor, staff, temp staffing employees, any type of contract labor. The question is, well, wait a minute, who's the employer? Is it the grower? Is it the farm labor contractor? At the end of the day, it's going to be a common law standard. And so, typically the way you set up farm labor contractors is they're the employer, not the farm. But anybody that knows anything about the employee misclassification concept knows that it's not too difficult in a lot of cases with leased labor to basically look at the user of the labor and treat them as the common law employer. So just make sure that if you're banking on a bunch of contract labor not counting as your employees for all of these purposes, that you have that arrangement set up properly so that you're not going to be treated as the employer. The next is properly identifying the controlled group. See a lot of agricultural businesses where there's maybe different farms are in different companies. Maybe there's different parts of the business are in different companies. You got to make sure you know which of those companies are going to be tied together for purposes of these rules. I see a lot of agricultural employers who are kind of behind the 8 ball on getting ready for the tax reporting requirements, starting with the 2015 year. You'll have to do new tax reporting to the IRS. You'll do this in the first quarter of 2016. Basically reporting to the IRS, how many full-time employees did you have? For each one of them, did you make an offer of coverage? Month by month, you're actually completing a return that indicates whether you made an offer of coverage. If so, how much did you charge, or did you fit into certain safe harbors? That can be a lot of data to gather up at the end of the year, as opposed to gathering it up throughout the year. And so make sure if you're a large employer that's going to have to do that tax reporting, that you're on top of it. Also remember that none of this is going to work out perfectly. There's going to be a lot of employers who are getting tax bills for penalties that they don't know. And most likely those penalties are going to be for employees who went out to the exchange and got tax subsidized coverage and you didn't even know it. And so my recommendation to any employer, it's a large employer, is get a written waiver of coverage from your employees. If you have employees that you're making an offer to and they're not taking you up and actually signing up, get a written waiver from them that you can stick in the file so that when you get the penalty bill down the road, you have proof that, hey, I did make the person an offer of coverage. The fact that they later went out and got tax subsidized coverage is not my problem. They're the ones that are going to have to pay back the IRS for that tax subsidy that they shouldn't have gotten. The next thing is just using all of the tools that are available to help manage the obligation. I mentioned all those transition rules for 2015. Those, of course, are going to slowly but surely fall by the wayside. But there's a lot of other tools that an agricultural employer can use to try to manage the obligation. We talked about that seasonal worker exception that might apply for some. But the big thing is that look-back measurement and stability period concept. And you know, the seasonal employee concept, those break in service rules, using those rules to your advantage to minimize the number of people who end up qualifying as full-time. That's how most agricultural employers are going to try to manage this obligation or manage their risk to penalties, is how they're going to use those rules to minimize their full-time population. As I mentioned before, there's this rule when you hire a full-time employee that you don't have to offer them coverage till the 4th calendar month. You know, some agriculture employers have a lot of short-timers where you're bringing people in, you know, for 2 months here and there, 3 months here and there. It may be that rule is going to, you know, save you from having to have an obligation for full-time employees. And then the last thing is just this concept of a skinny plan or a MEC plan. MEC stands for Minimum Essential Coverage. Some of you have probably been pitched this by your broker. The basic concept is in order to avoid that $2,000 a head penalty, you offer a really, really cheap plan that frankly, the benefits aren't so good, but you make sure you offer it to everybody, even if they have to pay full boat for it and it's not affordable. The theory there is that you've then checked the first box, that you've made an offer of coverage to each of your full-time employees. Once you've done that, you've eliminated your exposure to the automatic $2,000 per head penalty, and then your only risk from there is the $3,000 penalty for each employee who goes out and gets tax-subsidized coverage. We see a lot of employers, not only in the ag industry, but in other industries, offering that skinny plan as just a baseline protection against that $2,000 a head penalty. So that's another, you know, tool or planning opportunity that can be used. Okay, so I apologize. I know I ran a little bit over, but I'm happy to stick around for questions as long as anyone would like. And so I'll take a deep breath for a minute and turn the floor over to whoever's going to manage the questions.
Thank you, Sheldon. This is Bob again. Great presentation, a lot of great information. Hopefully you can catch your breath for a minute and maybe get a glass of water. You know, as a couple people have written in, texted in, that it's very complicated, and there's no question about that. It is complicated, probably a little frustrating to understand, and we understand that challenge. So let's go with the first question. With your clients, are you seeing any enforcement actions or audits on employers by the federal government to ensure employers are providing required coverage?
So the answer to that question is no, but I wouldn't take any comfort from that, because frankly we're not at a point yet where I would expect there to be any audits or enforcement activity. I mentioned earlier that the first round of tax reporting for large employers is going to be for the 2015 calendar year, and that reporting is going to be done in first quarter of 2016. It's really only after that first reporting goes in that the IRS is going to be in a position to audit or enforce or assess penalties against any employers. So I really don't expect there to be any enforcement activity until at the earliest, probably mid-2016. Keeping in mind that by the time we get there, for a lot of folks, we're already 18 months into the process, and it's going to be too late to go back and fix anything that happened during that period of time. So, just know that to the extent IRS has the resources, because we all know they're pretty strapped, the enforcement activity probably isn't going to kick in for about another year.
Okay. Next question, I think, goes back to one of your kind of early slides. It reads, employers may not reimburse employees from your slide. What is your recommendation regarding the use of Section 105 health reimbursement accounts? Are these no longer viable? What about between the farmer and spouse, with spouse as a sole employee with a 105 plan? Is that something you're familiar with?
Yes. So the 105 plan, or what's also referred to as a healthcare reimbursement arrangement, or HRA, that's the vehicle that allows non-taxable reimbursement for medical expenses. And if in the past you were doing it correctly, where you were offering to your employees to reimburse them for purchasing their own individual coverage, you would have been doing it through an HRA or a 105H program. That's how you would have done it on a non-taxable basis. Basically the rule now is you can have a 105H program that reimburses for health expenses, but it has to be what they call integrated with an offer of group health coverage. So, for example, there are a lot of what they call consumer-driven plans out there, where maybe you have a high-deductible health plan, and then you have an HRA that rides alongside it that reimburses people for some of those expenses that aren't paid for by the insurance because of the high deductible. You can still have an HRA or a 105H arrangement if it's integrated with or linked with a group health plan, but you can't have just a flat standalone 105 or HRA program that reimburses for individual market coverage. This is probably getting into the weeds a little bit, but I think whoever asked this question probably wants to get into the weeds a little bit. You can still have an HRA linked with an offer of group health coverage that says if somebody decides to opt out and buy coverage from their spouse's plan or some other type of group coverage as opposed to individual coverage, there are still some circumstances where you can reimburse for that. But the key is that they have to be offered your group coverage as well, and whatever you're reimbursing them for has to also be group coverage. It can't be individual market coverage or exchange coverage. But the basic reimbursement concept that we used to see a lot out there with smaller employers, where it's just simply a standalone reimbursement for health insurance premiums, that's the animal that doesn't work any longer.
Okay, that definitely was a little bit in the weeds, but an excellent response, and I'm sure that the person asking the question understands that better than I do. But that's great. No, fantastic. We have a number of other questions, and so I would just encourage participants, if you have some questions, please get them in. Next question: if an employer exceeds the 50 or more FTE test for only 1 month in 2015, does that 1 month cause the employer to be a large employer for 2016?
I would say the answer is no, because remember, it's an average across all 12 months. So I think the math, no matter what, would work out, so the average would be less than 50. If you're only above 50 for 1 month and you add the rest of the months in and you divide it by 12, by definition you ought to be below. I suppose that you could have a weird example where you had 1,000 employees in January and then 40 employees for the rest of the year, where it would skew the average above 50, but that would be a pretty extreme example. And even then, if the only reason you had 1,000 in January is because they were all seasonal workers, then perhaps that seasonal exception would work for you. So to back up, I would say in most cases the answer is no, but do remember that it is an average across all 12 months. So if for some reason the 1 month that you're above 50 is a huge number that's going to skew the average, then that's something that you need to take a look at.
Very good. The next question comes from one of our sponsoring organizations, but do you recommend that an employer document an offer of dependent care? What is your thoughts on documentation and this specific one on dependent care?
Well, you're inherently going to have some documentation that your offer of coverage included coverage for dependents, because you're going to have your certificate of coverage from the carrier or your plan document or your summary plan description, and that's going to show that there was not only employee-only coverage but dependent coverage as well. So I think if you just have the basic documentation in place that you should already have for a plan, you're going to have some documentation that there was dependent coverage. Now, if the question is more geared towards trying to document that dependent coverage was offered at the individual employee level, well, there again, you're going to have some enrollment materials, whether they're electronic or in paper, that should show the various options that were presented to the employee. And so I think you're going to have documentation there as well. Just in case what this person was getting at is maybe regarding the waiver that I mentioned, where I said I recommend that you get a written waiver from somebody. You're going to have some employees where you make an offer of coverage that's employee only or employee plus dependents, and even if they have dependents, they're going to sign up for employee only coverage. And so I guess there might be a question, well, okay, should you get a written waiver of coverage for the dependent piece that they passed up on? I don't think you need to do it that way, because if your enrollment materials show that offer was made, and then your enrollment form indicates that they checked the employee-only box instead of the employee plus dependent box, those two things together are going to indicate that they were made an offer of dependent coverage even though they decided not to take it. I've never seen anybody get a specific waiver of coverage in place for dependent coverage, and I think if that other documentation is in order, that it's not really necessary.
Okay. Again, Sheldon staying with us past 9 o'clock, so we still have another 5 minutes before 9, but we appreciate that very much, Sheldon. Next question, for the 9.5% test, if the employee gives you additional evidence showing additional income, can you use that information in determining affordability for that employee?
Certainly you can, but let's remember that you're setting your premium in all likelihood before the year even starts. So if an employee comes to you and says, you're going to pay me $20,000, and just so you know, my wife has a job and she makes $20,000, and you rely on that in setting the premium, you don't really know whether the employee's wife is going to make that money that year. Maybe she gets laid off early in the year. I mean, there's any number of circumstances. So if you're relying on that data, it's only going to be good as it turns out to be accurate. In other words, you're not going to be able to save yourself from a penalty because you put that in the file and say, well, gosh, he told me that the income was going to be 40 instead of 20 or whatever it turns out to be. So just take that data for what it is. It's just an estimate or a prediction, and it may turn out to be wrong. And that's why the IRS is allowing you to use these safe harbors, even though the safe harbors are oftentimes by definition going to be less than the total household income. It's a way to get comfortable that your rates are affordable, given that everything else is a moving target that's outside your control.
Okay. Sheldon, the next question. Do you have to consider contract employees as your employees?
Yeah, well, this gets to my point towards the end of the program about determining who the employer is. The issue is, who is the common law employer? And I assume the person that posed this question is talking about a contract employee that's maybe being paid by the labor contractor or the staffing company, whoever it is. In other words, you have somebody where it's not your company's name that's on their paycheck. It's the labor contractor or the staffing company. In most cases, it's going to be the name on the paycheck that dictates who the employer is. The problem is that doesn't always tell you who the real employer is, and that's where this common law standard comes into play. And the issue is who's directing and controlling the work. That's the primary test when you're looking at who the common law employer is. So for example, let's say you have a farm and historically you've had 60 employees on average. So you're looking at all this stuff and saying, gosh, I just can't deal with this new obligation. So you take 20 of your employees and you move them over to a labor contractor, and they continue to show up for work every day just like they have in the past. You continue to tell them what to do. As far as they know, they continue working for you. The only difference is their paycheck now has the contractor's name on it, and their W-2 has the contractor's name on it. In a situation like that, I think there's a pretty good chance if IRS looked at it, they would still treat those 20 employees that you moved over to the contractor as your common law employees, even though their paycheck was coming from the contractor. So that's kind of an extreme example, but the more difficult example is, maybe you've had an operation in place for years where there's just a certain segment of the workforce you're getting from a contractor. The question's going to be, okay, when the rubber hits the road, who's going to be treated as the employer? Is it the contractor or is it you? And the only way you can evaluate that is to look at the facts and circumstances. Who's directing and controlling the work, and who really is the employer as between the two parties. I would just tell you that if you're using contract labor, you're going to want to make sure that it's clear that the contractor is the employer and not you. You want to have a good contract in place that makes that clear. Ideally, the contractor will have some supervisory role with the employees. And to be on the absolute safe side, you're going to want to work into your agreement with the contractor that they're going to make an offer of coverage that's ACA compliant to all these employees, because in all likelihood the contractor is well in excess of 50 employees, because they're providing contract labor to lots of different operations. And that way, if you're later accused of being the employer, you can say, well, hey, I made an arrangement for these folks to get an offer of coverage from the contractor. It's right here in the contract that I have with them. So that's another way that you can protect yourself when you're using contract labor. But it's ultimately, there's always going to be a little bit of gray in a contractor situation as to who the IRS is going to accuse of being the employer.
Okay. Next question is really asking some clarification on the $2,000 and $3,000 penalties. Basically asking the question, if you owe the $3,000 penalty on one employee, is the $2,000 penalty dropped by $2,000? So I think there's some clarification there, Sheldon, as to whether the 3 and 2 can apply to the same employees.
Yeah, and the answer is no. You're only going to be subject to one of those two different types of penalties. Remember that the $2,000 penalty applies if you fail to make an offer of coverage to at least 95% of your employees. And so if the answer is yes, you didn't make an offer of coverage to 95% of your employees or your full-time employees, then you're subject to the $2,000 penalty, and that's the end of the story. You don't even get to the $3,000 penalty. Okay, you only get to the $3,000 penalty if you first make an offer of coverage to at least 95% of your employees, and therefore put aside the $2,000 penalty. And so when you get to that point, the exposure to the $3,000 penalty is again just going to be for those employees who go out, those full-time employees who go out and get subsidized coverage because the coverage that you offered them was either unaffordable or it wasn't minimum value.
Okay. Next question. If plan year starts June 1st, 2015, do I have to start January 1st, 2016, or can I wait till January or June 1st, 2016 to offer to employees? So the plan starts June 2015. Do I have to start January 2016, or can I wait till June 2016 to offer health insurance to employees?
Okay. So I'm assuming this is someone who, this depends on how big you were in 2014. And it also, there's a lot that goes into this. Somebody made the comment about this being complicated and getting into the weeds. This is going to a different level. So everybody just bear with me for a second. I'm going to try to give you the high level version of this one. So if you were between 50 and 99 employees on average during 2014, then you most likely would have qualified for the transition relief that got you off the hook for 2015. That rule said that you were off the hook for all of 2015 and the portion of 2016 until your next plan year started. So if you were between 50 and 99 employees on average during 2014 and you qualified for that transition relief, then it's clear that your compliance date for 2016 isn't until June 1. And of course, I'm assuming you're averaging above 50 during 2015. If for some reason you didn't qualify for the that relief, you may get what they call that off-calendar plan year transition relief that I mentioned, which says that instead of having to comply January 1, 16, you can push it to, in your case, June 1, 16, because you have that off-calendar year. However, there's a whole laundry list of requirements that you need to satisfy in order to get that off-calendar year plan relief. One of the requirements is that your plan had to be in existence back on December 27th, 2012. Which I know sounds absurd, but basically that's the date that the IRS first announced that it was going to allow this type of transition relief, and this is what the IRS does. They announce things like this, and then they lock it in so that somebody can't try to maneuver into the exception after the fact. So if that June 1 plan year that you had is on a plan that's been around since December 27th, 2012, and you haven't changed the plan year since then, then you can wait till June 1, but you will have had to have covered a certain percentage of your workforce ever since the December 27th, 2012, and so what I would tell you is you're going to have to sit down with your broker or a consultant or somebody like me and actually work through the precise facts of your plan going all the way back to December 27, 2012 to figure out whether that off-calendar plan relief is going to work for you. That's about as deep into it as I can get on an off-the-cuff example like this. So the answer is maybe. How do you like that?
Well, it's certainly complicated. Thank you for that effort. Next question. If I am a large employer and I hire a new employee July 8th, at what date do I have to start offering them coverage?
So let's assume this is a full-time employee hired on July 8th during a year where the employer is subject to the mandate. The rule is that for a new full-time employee, you have to offer them coverage by the first day of the 4th full calendar month of employment. So it's actually, let me go back to my slide and make sure that I got that right. This is the one that always escapes. Can you all still see my slides?
Yep. Yes, we can.
Okay. So look at the bottom bullet. New full-time employees subject to mandate on the first day of the 4th full calendar month of employment. So basically, since somebody was hired on July 8th, we put July aside. We have August, September, and October are the first 3 full calendar months of employment, right? August, September, October. So you'd have to offer coverage November 1st in that example, because that would be the first day of the 4th full calendar month of employment. So you basically get 3 months and a stub month for free. Now, if somebody was hired on July 1st instead of July 8th, then it would be October 1st, right? Because July, August, and September would be the first 3 calendar months. So I guess there's sort of an awkward incentive here to not hire people on the first day of a calendar month, because then you lose the stub portion of the month there. But in that example, again, assuming they're a full-time employee, you got to make that offer of coverage by November 1.
Okay. Very good. We have, I think, 2 or 3 questions left, so we are coming to a close. But if anybody has a last-minute question, please get it in. Very, very informative, Sheldon. Next question is, can you comment? Whoops, excuse me. Can you comment on the 1094-C and 1095-C forms now out? It seems like most payroll companies have already cut off assisting in reporting. Errors on those forms will probably trigger future audits. And then it goes on to say, will the state's labor departments get into the enforcement too?
Okay, so there's a lot in there. So the 1094 and the 1095 IRS forms are the forms that you will do the new reporting on in the first quarter, starting with the first quarter of 2016 for calendar 15 that I mentioned. And basically, the 1094 is the submittal form that you give to the IRS with all the data that the IRS needs. It's sort of the functional equivalent of the W-3 for those of you who are into the payroll forms. The 1095 is the form that you're going to distribute to the employee. You're also going to give a copy to the IRS, and it's sort of the functional equivalent of the W-2. It's sort of, think of it like a healthcare W-2 that's going to show the employee what coverage they were offered during the year, and then they'll use that for their tax return, and then they will also you will also give a copy of that to IRS so that IRS can see who you made offers of coverage to and on what basis. This is how the IRS is going to enforce and audit this. They're going to collect these forms, they're going to collect individual income tax returns, and then they're going to collect all the data from the state insurance exchanges about who got coverage and who got subsidies. All of that goes into the black box, and then out the other end spits the penalty assessments for the employers who didn't satisfy all of these rules. I have heard that a number of the payroll vendors or just the vendors that are doing specifically this ACA reporting are having sort of deadlines or cutoffs where if you didn't start working with them or get your data to them by a particular time, they're not guaranteeing that they're going to be able to help you. I'll tell you, there's a lot of nervous folks, including the vendors that are doing this, about being in a position to get this done right the first time. The IRS has said that the first go-round is going to be a good faith compliance standard, meaning that they've already anticipated there's going to be a lot of mistakes with this initial round of reporting, And so, I think they'll be a little laxed in at least in the reporting piece of it, and whether or not the forms were completed properly. But in any event, it's something that you need to do. If you haven't connected with your payroll vendor or whatever other vendor you're going to use to work on this, you should do so tomorrow morning. And start gearing up for it, because it's a lot of new data to be gathered that you can't pluck out of a payroll system. Your payroll system is not typically capturing who has made an offer of coverage for which month of the year, and how much they were charged for each month of the year, and lots of other data that goes into it. So it's a whole new piece of payroll reporting and data that's being captured. I think a part of the question related to whether the states were going to get involved. I don't think the states are going to get involved at all in the tax reporting piece of it. It's purely a federal issue. If the question was intended to be broader than that, as to whether the states were going to get involved just in enforcement in general for the mandate, I also don't think the states will get involved in that, because again, it's a federal law issue. The only place that I would expect the states maybe to get involved is, we always have the sort of classic employee misclassification issue, where the question is whether you're calling people contractors instead of treating them like employees. And if you're not, if you're not doing that right, there are lots of issues that come up. There's unemployment insurance, taxes, workers' comp, all sorts of things at the state and federal level that you're not satisfying if you're misclassifying people, where now we have this new issue where you're also not, probably complying with the mandate if you're misclassifying employees. And I suppose, in the state enforcement of those misclassification issues, they may, tip off the IRS or take, the mandate or offering coverage into play in some of the analysis that they do. But I wouldn't expect them to have any direct enforcement role, if you will, with the mandate.
That's the one good thing that we pointed out tonight. That's good. We'd love to see our state agencies stay away from enforcement on it. Two last questions, Sheldon, and we'll wrap it up. Just want to confirm in this last question, are any of the penalties you talked about tax deductible in the year paid?
No. That's,
Okay.
I mean, and that's a key point. I mean, these are excise taxes, which are clearly not deductible under the tax code.
And I believe the last question of the night, with a control group and one or more companies, can you offer different plans that are all affordable? Are there any discrimination provisions that would affect the company? If on one company we pay in excess of the 9.5 and others we meet the 9.5. So did I get that out okay? Do you have an idea where that's going?
I understand.
Okay.
Yeah, I understand what they're getting at there. Okay, so as I mentioned kind of towards the end of the program, the ACA includes some non-discrimination rules, which are tax code-based non-discrimination rules that try to prohibit discrimination in favor of highly paid employees, which again are your top 25% of employees ranked by annual pay. We don't know exactly how those rules are going to work just yet, and that's why they're not being enforced right now, because IRS has to issue regulations first. Imagine that, like they'd have to tell you how to comply before they're going to enforce the rules. And so we're not exactly sure, but I suspect, and I think this is a pretty good bet, that those rules will be enforced on a controlled group basis, meaning that if you have closely related companies providing different plans, like the example here, that will have to pass muster under these discrimination tests as if all the separate companies were one employer. Otherwise, it would be too easy just to break up your company into multiple companies in order to skirt around the discrimination rules. So when those rules come out, I do expect that they will be applied on a control group basis, and I also suspect that if you're providing a really rich plan in one control group company and a much less rich plan in another related controlled group company, that it's quite possible that that will not work under discrimination rules once they come out. However, that being said, if you're doing this today, and if the plans you're offering are all fully insured plans, which are not currently subject to those rules, I don't think there's any reason for you to turn it upside down just yet, because the rules don't exist, and we won't know what they look like until they come out. So for the time being, I think it works, but it is something you're going to have to keep your eye on for when those rules eventually come up.
Sheldon, that's great. There are no other questions. A number of people have text chatted in their appreciation, highly effective presentation, great presenter, and so on, and we echo that very much so. I want to give you a last chance, so any last words or last thoughts to the employers that are on this webinar that you would like to make?
Well, I would just encourage everybody to to once and for all, if you haven't already, get your arms around this stuff and address it. I really don't think it's going to go away. I don't think there's going to be any magic political solutions or judicial solutions or legislative solutions for that matter. I think there will certainly be some tweaking of things as the years march on, but I think that by and large these ACA rules are here to stay. So there's no time like the present to make sure that you're getting into compliance. And I guess I'll just apologize. I should have apologized in advance for the complexity of this stuff. Hopefully we don't shoot the messenger. There's only so much you can do to break this stuff down, and I hope everybody enjoyed the presentation and was able to understand at least the basics for now.
Well, it was an excellent presentation, and we're very fortunate that you would join us, and we really appreciate the relationship that we have with you and your willingness to come out to the Northeast and do face-to-face meetings occasionally, as well as to do this webinar. So our big appreciation to your efforts, and great presentation. I just want to note for the attendees today that today's presentation will be posted up on farmcrediteast.com/webinars. It will be up by tomorrow afternoon. And if there's any further questions, please go ahead and email our Director of Knowledge Exchange, Chris Lawton. That's chris.lawton@farmcrediteast.com. Also, if you have any suggestions for us for webinars, please feel free to shoot an email to Chris. I do want to thank Chris Lawton, Director of Knowledge Exchange for Farm Credit East, for tonight's work. Chrissy Schmidt, our Director of Marketing Communications, and Heather Hunt, all who have worked to make this webinar a success. With that, Sheldon, thank you so much, and I'd like to say good night to everybody that participated on today's webinar. Take care.
All right. Thank you. Bye.
Thank you. Bye-bye.